Hello traders, and welcome to this educational video from Exness. Today we're going to be discussing briefly types of participant in markets and what they can mean for events on charts. Now, assuming you're not an absolute beginner in trading CFDs, you'd be aware that markets traditionally consist of traders, hedgers and investors. Investors who are primarily looking at the long term, traders who are basically speculators looking at the short and to a lesser extent the medium term, and hedgers, typically investors acting as traders in the opposite direction of their investment positions. What does this actually mean for the charts? Usually, large and small traders, whether their approach is long or medium term, have significantly different effects on charts. Large traders typically drive what we call fundamental movements, that is to say, several consecutive periods. For example, this relatively long-term upward movement here, of movement in the same direction. Usually, this means when we have consecutive or more or less consecutive in the same direction for 5 periods or more, whereas liquidity-based movements are what are typically driven by smaller traders. For example, here, when we have usually 3 or fewer periods of movement in the same direction. Generally speaking, as a trader, you want to avoid joining liquidity-based movements unless you're trading for the very short term, and generally, you want to try to join fundamental movements, again, unless you're trading for the very short term. Less commonly cited categories of participant in markets include contenders, pretenders, and spectators, and all of these, very basically, are traders, or not necessarily traders, but participants of some sort in markets who are trying to tell you what to do or encourage you to do something, and it's often not a good idea to listen to them. So in summary, it's key to bear in mind what it is that you are trying to be. You're trying to be a trader or a hedger or an investor, because it strongly affects your approach to trading, your strategy, and your management of risk and various other factors. Large and small traders trade significantly differently. Fundamental movements driven mainly by large traders are what you usually want to join, while liquidity-based movements are ones you want to avoid. And generally, it's a good idea to avoid taking any specific advice or recommendations from anybody when it comes to trading. Thank you for watching Exness's educational video introducing the types of participant in global markets. If you found this video informative, we definitely encourage you to continue to watch the various other videos in this series.